to the Money RX for CRNAs podcast, where you go behind the scenes with host Brett Fellows, CFP, as he explores the unique opportunities and challenges facing certified registered nurse anesthetist along the path to financial independence. In each episode, Brett shares expert insights and actionable advice, equipping you with the tools you need to take control of your financial destiny and retire on your terms. And now, here's your host, Brett Fellows.
Welcome, everyone, to the Money RX for CRNA podcast. So, for most of you, the bulk of your retirement nest egg will be in your 401k account or your 403b account. And accordingly, with that, your monies will grow because they are invested in the stock market. So naturally, in our work with CRNA clients, investing in the stock market is a crucial component of a well-rounded financial plan. And yes, while there are risks involved with investing in stocks, the potential for long-term growth and future financial stability will far outweigh the risks. Why is this, you might be wondering? Well, historically, the stock market has produced higher returns on your money compared to other investment vehicles such as real estate or bonds and savings accounts. And as we sit here in 2024, with the advent of technology and online investing platforms, it has become easier than ever before to invest in the stock market. So for today's episode, I will delve into the top reasons why investing in the stock market is a smart financial move for CRNAs, and why you should consider getting started now. To get started, I want to talk about why investing in stocks is so important, and I think there are 5 main reasons. The first reason is the potential for higher returns. By investing in stocks, CRNAs have the potential to earn higher returns through compounding interest, which I will talk more about later, on your money and subsequently build long-term wealth. The second reason is diversification. Now, for CRNAs, this is really important because for most of you, 85% of your net worth is tied up in your ability to earn a large income. So investing in stocks will allow CRNAs a passive way to diversify their net worth, which means spreading their investments across multiple companies. Again, not just the business of anesthesia. What this does is helps to reduce the overall risk of their net worth and portfolio as a whole. And often any losses in one area may be offset by gains in another. Now, the third reason has really not been a huge issue for most of you listeners until 2022 and 2023, and that is an inflation hedge. Because stocks can serve as a hedge against inflation, which has spiked itself to the highest it's been in 40 years. Now, stock ownership acts as a hedge against this, as the value of stocks generally rises with inflation over the long term. The fourth reason is ownership in companies, which I just referenced in diversification. And this is probably one of the most important points. People seem to think you can create wealth or make money through work. Well, the reality is it's probably not going to work that way. Now, in regards to the stock market, when CRNAs buy stocks, you are essentially buying ownership in companies. This gives you the potential to benefit from the company's profits and growth. And you benefit in 2 ways. First, being a stockholder, as the value of the stock increases, so does your share of ownership. And second, companies pay dividends, usually in the range of 3 to 4%, to the company owners. Again, who are the owners? The stockholders. The same line as the others, the fifth reason it's important for CRNAs to own stocks is flexibility. Investing in stocks will provide CRNAs with flexibility in terms of when they buy and sell their shares. This doesn't happen in private companies. So this allows CRNA investors to take advantage of market fluctuations and then make strategic investment decisions based on their financial goals. So overall, investing in stocks can provide CRNAs with the potential for higher returns, diversification, a hedge against inflation, ownership in companies, and flexibility in their investment strategies. Now, it's not lost on me that all of those 5 reasons are pretty overarching. So where's the sexy stuff? How much can stocks really grow my money? What are some actual numbers? Well, stocks have been a reliable source of long-term growth since 1926. According to historical data, the U.S. stock market has produced an average annual rate of return of 10% since 1926, which includes reinvested dividends. So with that, it's fair to assume that we could define a normal market as an annual return close to that long-term average. And to put that into some perspective, there's what's known as the Rule of 72, and it essentially means that if you're averaging 10% annual return, your money should double every 7.2 years, even without adding anything else to it. So if I invest $100,000 today and it earned an average of 10% return, I could have $200,000 in 7.2 years. Make sense? Now, guess what? And you all experience this better than anyone else as a nurse anesthetist. Life is not linear. Nothing goes in a straight line. It's reasonable to think that an annual return in this range would be a common occurrence, but this has not been the case. And here's the data on that. Over the last 96 years, the market has returned between 8% to 12% just 4 times. But yet the average is still 10%. It's pretty amazing, don't you think? Because while the stock market has experienced periods of volatility and declines from those eventual unknowns like the Great Depression and the recent global crisis, the stock market has ultimately rebounded and continued to provide CRNA investors with long-term growth opportunities. And it's for this reason that so many financial experts believe that the stock market is one of the best long-term options to build wealth over time. That said, and you may have noticed I just introduced some what if this happens to the conversation, we all have to consider our own capacity for risk when we decide to invest in the stock market. So let me explain risk. This refers to an investor's ability to tolerate financial risk and potential losses without experiencing undue financial hardship. So a CRNA with a higher risk capacity may be more comfortable with investing in the stock market as they have a greater flexibility to absorb potential losses and a longer time horizon to recover from any market downturns. On the flip side, a CRNA with a lower risk capacity may be more conservative with their investments, as they have a lower tolerance for risk and may not be able to handle potential losses as well. So I hope you can start to see that it's really important for CRNAs to assess their own risk capacity before investing in the stock market and to choose investments that align with their financial goals and risk tolerance. And also on this, I mentioned diversification earlier as an important reason to invest in stocks. And that comes into play here too. Diversification is an important risk management strategy when investing in the stock market. And what this means is by spreading investments across different sectors, companies, even countries, CRNAs can help mitigate the risk of any one investment or sector negatively impacting their overall portfolio. Okay, so if that makes sense, if stocks are at the one end of the stock market in terms of getting the most amount of return, but possibly also a higher amount of risk, what does the other, more conservative side look like? And probably the most relevant investment on the other side is what's known as treasury bills. Now, I told you earlier that since 1926, the U.S. stock market has produced an average annual rate of return of about 10%. Well, Treasury bills have produced an average annual return of around 3%. Not surprisingly, investing in Treasury bills is considered less risky than investing in stocks, as Treasury bills are considered a safe haven asset and are backed by the full faith and credit of the U.S. government. Treasury bills also provide investors with a guaranteed return, whereas returns on stocks are not guaranteed and are subject to market fluctuations. And on top of that, the performance of the stock market and Treasury bills can vary depending upon market conditions and economic factors. For example, during periods of economic uncertainty or recession, Treasury bills may be seen as a safer investment option compared to stocks, again because they are backed by the U.S. government and provided a guaranteed return. I want to switch gears a little bit as I think it'll help put things into better perspective and go back and revisit compounding interest, because this is an essential concept in finance that I really believe most of us take for granted. And that's the ability of an investment to generate earnings not only on the initial amount invested, but also on the accumulated interest over time. And in simpler terms, it means earning interest on interest. The concept of compounding interest is essential for long-term investments such as your retirement savings because it allows for the exponential growth over time. Let me give you an example of this, as I think it's the best way to understand how important this concept is. Suppose you invest $100,000 in a savings account, and I'm purposefully using big numbers here to create more of a wow factor. And this savings account has a fixed interest rate of 5% per year. So each year, it's going to give you $5,000. So if you withdraw that $5,000, you take the money out at the end of each year, and you add it back to your initial principal, at the end of 10 years, you will have $150,000. However, if you reinvested the interest earned every year, you don't take the money out, you leave it in there, your investment will grow to $160,000 after 10 years. So that's the difference in growth is due to the power of compounding interest, $160,000 versus $150,000. And the importance of compounding interest I can further highlight by the effect of time on investment growth. The longer the investment period, the greater the impact of compounding interest. And even the smallest of differences in the rate of return can have a significant impact on the total return over time when it's compounded. For example, an investment with a 6% annual rate of return over 30 years will grow to approximately twice the initial amount invested, so 100%, while an investment with a 3% annual rate of return will only grow to around 44% more than the initial amount invested. So 3% more interest means 56% more gain. That's the impact of compounding. So I hope you can see how crucial this is to take advantage of compounding interest by starting to save and invest early and allowing time to work in your favor. In the spirit of making this all a little bit more tangible, I now want to show you how things have happened with the markets more present to today, because this is more familiar to us. During the Great Recession of 2008, Treasury bills, which we talked about as a safer investment, outperformed the S&P 500 index, which tracks the performance of the 500 large cap U.S. stocks. In particular, from October 2007 to February 2009, which was the peak to trough, the highest to lowest point of the Great Recession, the S&P 500 index fell by over 50%, while Treasury bills actually provided positive returns. So this means that CRNAs who invested in Treasury bills during this period would have made money, a positive return on investment, while those who had invested in stocks would have experienced huge losses. During the COVID-19 pandemic in 2020, the stock market initially experienced a sharp decline. It actually fell 33% in 16 days, as investors responded to its uncertainty and the economic disruption caused by the pandemic. However, The market then rebounded and reached new record highs. It was actually up 75% 1 year later, largely due to the unprecedented government stimulus measures and low interest rates. So overall, while the stock market's response to pandemics and other major economic events can be difficult to predict, historical trends still suggest that the market has generally been resilient in the face of these challenges and has always recovered over the long term. Now, I just used a word there that's hugely important, and that was predict. It is impossible to predict and time the next market drop because of the unpredictable nature of our world and future events. I mean, think about it. How many things you would have to get right? The financial markets are influenced by a wide range of factors like economic data, geopolitical events, corporate earnings reports, and investor sentiment, just to name a few. In fact, these factors are so hard to predict in time that the stock market is actually a lagging indicator of how things are going, not a leading indicator. So instead of trying to actively time the market or seek advice of future events that nobody in the world knows, and that's why financial advisors like myself recommend that CRNAs instead focus on developing a long-term investment strategy, again, based on their goals and their risk tolerance. This may involve diversifying your portfolio, like I talked about earlier, by regularly rebalancing your holdings and, most importantly, helping you avoid making impulsive investment decisions based on short-term market movements. Ultimately, the feeling that you get of this time is worse, it feels different. Well, guess what? It isn't. So staying focused and disciplined and diversified, you are better positioned to weather the ups and downs of the market over the long term. Always stay the course. Now, the last thing I want to talk about is this idea of creating a diversified portfolio to spread out investment risk and potentially increase returns. Now, we do this for our clients, and you can do this on your own, but I would not recommend it. I definitely would suggest that you work with someone like myself, a CFP, and or an online service like Fidelity Investments, Charles Schwab, or Vanguard. But here are the 3 steps we go through for our CRNA clients. Number 1, and shouldn't be surprising at this point, is to determine their investment goals and risk tolerance. Before we can create any type of a globally diversified portfolio, we have to understand your investment goals and risk tolerance. And clients' goals may include factors such as retirement planning or saving for a specific goal or generating income. And their risk tolerance will then help us determine the types of investments that are appropriate for them, as well as how much risk they're willing to take on in order to potentially achieve higher returns. So that's number 1. The second thing we do is select a mix of asset classes. Once we've determined with our CRNA clients their investment goals and risk tolerance, we can then begin selecting a mix of asset classes for their portfolio. And asset classes refer to different categories of investments, such as stocks, treasury bills, and other types of bonds or real estate, commodities, and more. And a truly diversified global portfolio should also include a mix of asset classes from different geographic regions, as well as a mix of asset classes that have different risk profiles. An example of this is having both U.S. and international investments. And then lastly, the third thing we do is choose investments within each asset class. For example, within the stock portion of a client's portfolio, we might choose a mix of large cap companies, mid cap companies, and small cap companies from different regions of the world. Conversely, with the more conservative or bond portion of their portfolio, we might choose a mix of government or corporate bonds from different countries. So you can see now why I recommend that you not do this on your own. It's really important to research and carefully select investments that align with your investment goals and risk tolerance, and then to periodically review and adjust your portfolio as things change, because guess what? They will. All right, so let's wrap up today. I hope you found this episode helpful as you potentially begin investing in the stock market. And given that everyone is different and everyone has unique needs and circumstances when it comes to investing, it's nearly impossible for me to cover everything here on this podcast. So if you have any unanswered questions about investing or asset allocation or diversification when it comes to investing in the stock market for your financial future, or maybe you need a recommendation or a resource, please do not hesitate to reach out. You can shoot me a note. My direct email is brett@oakcapitaladvisor.com. Or you can actually directly schedule time with me by going to our website, oakcapitaladvisor.com, and click the free pre-op assessment link in the top right part of the page, where you can schedule a call with me at your convenience. And take a minute too and give this show a review on iTunes or wherever you listen to your podcasts. We'd really appreciate that. And that would make it easier for other CRNAs to find us when they're searching for podcasts. So thank you again for listening to this episode of Money RX for CRNAs. And until next week, take care.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.